Right. I am Solomon Litterer, and we are back for installment 3. I'm Solomon from Blackmatics. We're here with Alice Towns from Perkins Coie, we're going to walk through some of the tax and crypto issues for this year. This is a bit of a lead-in to our crypto and tax event that we're doing March 6th here in New York. So we're going to do a little bit of a preview of some of this really complicated topic. So Alice, maybe you could just give us a little bit of an intro on your background and kind of what you are doing in the crypto space.
Sure. So I am at Perkins Coie, which is a law firm based in the West Coast that has a significant blockchain practice. And I'm really lucky to be here because since 2013, I've been as involved as I can be in blockchain. And the reason why I started working on it in 2013 is in 2013, I graduated from my tax LLM in New York and moved to the Bay Area. And that was the topic of the day. And I've been hooked. So as a tax specialist in 2013, I had a lot of difficult conversations. The conversation has become less painful. And so I'm really happy to still be here and still be a part of it.
Okay, so I am curious to actually on that point, what you mean that it's gotten less painful. To me, it seems like it's gotten messier.
Well, people are still creating really unique challenges for tax attorneys. But I'm not, maybe it's my own perspective, but when things are complicated and we have a gray area and we have no guidance, I'm not scared. And you shouldn't be either. What was really worrying to me in 2013 was how people were not prepared mentally for the news that they were engaging in taxable transactions. And when I had to be the person to tell them that, a lot of people just walked away. And when you lose the opportunity to help somebody because they can't even begin to have a conversation with you, it's a really difficult position to be in as an attorney. But now people come to us and they say, we have a question. How can you help us? Which is a much better position for me to advise from.
You're right. So. Yeah, I think that's probably the biggest theme is that people don't realize that they're actually involved in taxable transactions, or people think like, well, I'm just exchanging one currency to another, or I am buying some digital asset. So for instance, like as an example, if somebody is buying a crypto kitty, right? So they're just taking one ether that they have, they're buying a crypto kitty, they're holding on to it. They think, well, a lot of people just don't pay much attention to it. So what are the tax implications, number one, on making a purchase like that, but then also if you subsequently sell that crypto kitty? So you bought it for one and now you're selling it for two.
I like that you picked crypto kitties, but obviously what you mean is it's used as an example, right? You're talking about just generally how that transaction would work with most tokens. But it's easiest to talk about crypto kitties because, so let me step back. So this is one of my opportunities here in this webinar and also on March 6th is to help everyone who's in the audience become a little bit of a tax attorney. And I don't mean to say you're going to be qualified to practice law after we have this conversation, but I want you to understand how I would think through a problem. And this was a problem. In 2013, we were like, what's Bitcoin? Now we're like, what's this new token? And we're still having to start from the basics of, how does tax work in this brave new world? And so I think we still enter every discussion with, what is this thing for tax purposes? So with a crypto kitty, I think you probably have an idea that the asset is actually the crypto kitty is actually a piece of property, and that it's probably intangible, right? It's an intangible piece of property because a crypto kitty is a cute little thing that maybe you think of like a Pokemon card. And so it's pretty easy for you to sort of identify the crypto kitty token with a piece of property. What's more subtle is how other tokens become property. And ultimately, the way the tax system works is it's based on transactions. And so when the tax system is not a system that taxes assets that are in stable form that aren't being transacted with. Until a transaction occurs, tax doesn't come into play. So detecting and measuring transactions is the entire exercise of taxation, especially in the US, but in many other countries as well. And a transaction is built on the principle that an exchange of value has happened. So ultimately, a CryptoKitty or even any other kind of token is property, or is at least a transaction event to the extent value is exchanged. And so once we've identified that fundamental principle, we then need to ask questions about how the tax system would interact with that transaction. And the basic rule is that you tax it as a property transaction. And the sale of property is the most basic form of taxable transaction, and it's the design is that you recover your purchase price, and then any increase is taxed as income. So your CryptoKitty, when you purchased it for 5 ETH, and depending on when you purchased the ETH, you may have actually seen an increase or a decrease in value from the date that you purchased it. So whatever that change in value is, you recognize it, and that's a term of art in tax. You recognize that gain or loss, and if it's a gain, you will pay tax on it. If it's a loss, it could offset your other gain. And then you hold a CryptoKitty, and your CryptoKitty purchase price is the fair market value of the Ethereum you used to purchase the CryptoKitty. So you almost start again fresh, as if you bought the CryptoKitty for cash.
Gotcha. So essentially it's right. So there are two events that are happening here. At the time when you purchase it, you have to figure out whether you're gain or loss on that transaction, in the sense of you're essentially like selling your ETH at that point and determining whether or not you had a gain with that. And then again, when you sell the CryptoKitty, that would be another calculation, whether or not you gain some new ETH from that. So you're right. I could see how that maybe is a more tangible case. And so people should be aware, obviously, when they're buying some digital good, that they're buying property. But you're right. Like, I guess in a more general sense, if you are even buying another cryptocurrency with your ETH, so if you're just exchanging your ETH into, let's say, EOS tokens, a lot of people are still, well, I guess in 2017, there was possibly this like-kind exchange that you can maybe you could use, but for this tax year, that's no longer the case. So is it what you were describing with respect to CryptoKitties, is that then exactly the same if you were to go from, let's say, Ether to EOS?
Yeah, and it's important to remember that tax law is math for lawyers. So everything is very simple. And if you remember that, then you have to, if you can't explain a tax principle in a way that would be understandable to a 5-year-old, you haven't truly understood it, because it's intended to be that simple. And so generally,
I don't know if people would agree with that one, but
well,
only in a sense. I'm 37. I can't figure this out.
You've got 90% of the way there. Yeah, I mean, it really doesn't get any much more crazy than that, or that much more crazy than that. But what I mean to say is, the baseline for any tax consequences from a transaction is an addition and subtraction process, right? Where you determine this basic concept of what value did I receive, what value had I previously spent, and what's the difference? And that question is basically the answer. Like-kind exchange fits in as an exception, where if you appropriately document a transaction, you can, in theory, not recognize the gain. So the event has still occurred, but we then change the tax answer by the time we file the tax return, the tax answer is different. So within that framework, up until January 1, 2018, based on a very complex legal analysis of what a like-kind piece of property would be in this context, some people have taken the position that their transactions were like-kind exchanges. However, it doesn't actually make life easier, and it doesn't really change the long-term outcome of your transactions, because you just preserve that gain for future realization. The reason why it was incredibly important in 2017 is because the value crashed. So for a lot of people, they preserved the gain, but then it went away. So they never had to pay the tax on the gain that was built into their tokens in 2017. So
Right.
I think that was a great opportunity for well-advised taxpayers to protect themselves from a result that was really not reflective of the economics. And so but the baseline, the IRS is likely going to challenge that position. They're already auditing the 2017 returns that took that position.
Oh, really?
And
So with the like
yes.
kind, you're saying that they are challenging even that.
Well, we don't know what their argument's going to be yet. All we
Mhm.
know is that they're auditing those returns.
Right.
And a couple of my colleagues in the Bay Area who are tax attorneys in the blockchain space are representing their clients in these audits. And that's an incredibly fast turnaround for an audit, especially with the IRS and the condition that it is.
Right.
So I think the IRS is gearing up to challenge, and we don't know what their argument's going to be. But taxpayers are entitled to take the position, the most aggressive position within the bounds of the law on their tax returns. So if the IRS disagrees, you can either, if it's legal and fully, and you have a strong basis for it, you might only pay interest on your tax. If there's an aspect to the transaction that's overly aggressive, you would then pay penalties. And if you find yourself taking a position that goes beyond what we call aggressive and is actually somewhat of a tax protester position or tax evasion position, then you might have criminal penalties apply.
Gotcha.
So people are able to take that position if they review the law and they view that the law supports that position. And so I think a lot of people did.
Is there any kind of room in terms of, like you started off the conversation, we're mentioning that people are not even recognizing or aware that what they're doing is actually a taxable action, right? So like you said, anytime there is essentially a transaction that is taxable. So, getting back to this example with Ethereum, you convert that into EOS. People maybe don't really know or think that you have to really pay taxes, or you should really allocate some money that you're paying, to pay taxes on that transaction if you had a gain. And what's happening is, especially since 2018 was very much a bear market, the prices really plummeted. So if somebody made that transaction at the beginning of the year, where presumably they had a very big gain, right? So they're buying, let's say, they have, let's say, 100 Ether, and they're converting that into EOS, and maybe on that 100 Ether, that transaction, it's a sale of some sort. Maybe they've made $10,000, but now if they hadn't taken a loss at the end of the year, and now they find themselves in a situation where maybe they owe $5,000 in taxes, and on paper, this maybe looks like that is there, maybe even some criminal action, or, well, obviously, there are two parts of this. Question number one is, has there ever been case scenarios that are akin to this, where I'm sure there are a lot of people for this year, they are going to owe a lot of taxes on, and they don't even have the money to pay it. So I'm sure a lot of people had hundreds of thousands of dollars in actual end of the day losses, but their actual tax liability from some purchase at the beginning of the year, maybe they owe hundreds of thousands. So what is their recourse in that scenario, and where has this come up before? So that's question number one. So
I had an interesting December, because there are solutions that can be achieved in the same tax year. Mm-hmm. And for individuals, that means the same calendar year. So if you pardon the sort of diversion, if you had identified this issue in the same tax year, the solutions are available to you, and they are twofold. One is, if you engaged in a transaction where you recognized a large amount of gain when you purchased a token, and that token later crashed in value, if you then sold that token in the same year, you would have an offsetting loss on that token. Because remember, when we were talking about the CryptoKitty, the fair market value of that token becomes the basis in that token. So what you've done is you stored that history in the new token. And so that history of gain recognition persists, and you sell the token, then you recognize a loss and you can offset your gain. That doesn't work if you don't do it in the same tax year, because we don't allow carryback of loss anymore. Mm-hmm. And so that's solution one. Solution two is, in certain circumstances, you can actually rescind transactions. Now, rescinding is not a tax concept. It's a legal concept. So within the legal, like regular contract law world, one can enter into a transaction that you regret, or somehow fail to document it correctly, or do something wrong, like sell the wrong house or what have you. I mean, you can just imagine the chaos. You can rescind that transaction. And the tax law says, if you rescind a transaction appropriately within the same tax year, it is as if it never happened. So those two opportunities are available before December 31. But now, obviously, we're back to your question. It's 2019. We are not able to do any of those tricks. The taxpayer is going to file a tax return that reports a gain that results in the calculation of tax that is a number that they can't afford. Right. And the immediate step is to enter into an installment agreement with respect to those taxes. And to be clear, your tax is due sometimes earlier, but at least by April 15th. So the payment, there is no extension of the due date for payment. Mm-hmm. So the payment is due April 15th. So if you haven't set up an installment plan for paying your tax by April 15th, then interest and penalties can accrue. However, they're manageable. It's better to deal with this problem now rather than later. And so an installment sale is available. And in true extreme circumstances, there are ways in which you can approach the IRS where the actual liability itself can be mitigated. And accountants and lawyers assist taxpayers all the time with these problems, because so many people get rich quick, burn through their money, and then are just stuck. This happens to entertainers, for example. We have clients that are in the entertainment industry who are sports stars for a short period of time, that or even in Silicon Valley startups where they cash out like a large equity incentive that they received on an IPO, and then they burn through the cash and then they can't afford the tax. So it happens to ordinary people outside of blockchain, and IRS has a system set up because, and this is the real critical point, the IRS's entire goal is to turn us all into good taxpayers for the rest of our lives, right? And if they have a situation now where they've created a mathematical impossibility that you could never pay the tax, under any circumstances. What they've done is they've alienated you from the system. They've made you into a bad taxpayer, and they can't bring you back into the system and make you a good taxpayer unless they make concessions.
Right.
So the IRS
That's a great point.
So the IRS has like a mandate to continue to collect tax from you for the rest of your life. And so their motivation is not the dollars today. They're thinking very long term. And they also are not thinking about it in terms of how many dollars they're going to collect from you, so much as how do I create an administrative system that allows this person not to be a criminal.
Right.
And so that's their one of their mandates in this, and it gives me comfort. I hope it gives you comfort that that's part of their considerations.
Right. And I wonder then, that's really nice to hear, number one. I wonder if that will maybe be an impetus to sort of maybe changing some of the law around this, because, I think the distinction with the examples that you gave with, let's say, an athlete or a startup founder that cashed in a lot of money and then they just blew it all. So in those scenarios, you actually were holding dollars. So it's very, or close to it. So it's very apparent that, yeah, you made a lot of money and you have this tax burden. But in the case of crypto, a lot of people are just being like, well, I'm never even getting money in the first place. Like, I never even had the money. Like, it was just, it went from one digital coin into another.
Right.
And then they just didn't realize, like, now it totally crashed, and they don't, like, they feel like there was never a dollar in their pocket to begin with. Yeah, so that's, I guess, kind of, and you kind of addressed my second point on that, is with respect to how much of a criminal activity would be. But you were saying that in terms of you're giving some solutions. So basically, like, the IRS try to work with you. I want to get to another thing that you kind of alluded to, and that is, we were saying that when there's a transaction, that's a taxable event. But now we're also getting into a lot that's been happening this year, or starting to happen a lot in the crypto space, is people are gaining cryptocurrency, or they're earning it, or getting it in some way very passively. That can be whether you're earning staking rewards. So certain blockchains like Tezos, for instance, it's very easy. Like, your coins you just keep them in the Tezos client app, and it's essentially just generating new coins. There's like very almost minimal effort in that sense. Or there's scenarios where people are getting airdrop tokens. Maybe there are fort coins, or various scenarios. I mean, we can even go into certain apps that are giving you rewards for staking your coins. So anyway, this is a pretty open question, but my question to you is, what is your obligation with respect to the, like, passively earning or gaining new coins or currency?
Yeah, and that's a great question. There's both good and bad in that. The good news is that since there is no guidance, a reasonable approach is going to be, there's going to be more latitude for taxpayers to just adopt a reasonable approach that is, just consistent with the tax rules and shows a good faith effort. There are people who've speculated as if there's existing tax rules that could apply, and I really don't think tax practitioners would agree with that. I've heard many of my colleagues in this space talk on this issue, and they're all saying that there's no clear answer. So just the highlights are, you can experience a taxable event one of two ways. One is that you've received value and you've had a transaction, right? But the other consideration is that transaction results in income, right? So one question you should always ask as you receive any kind of passive income is whether that passive income had value on the date that you received it. A good example is airdropped newly minted coins. Did they have value on the date that you received it? Because you may have received it, but it's not even reportable on your tax return if it has a zero value. You know, there's no money there. There's no number there. So so always take a step back and think about that question. And I think that's also true of hard forks. And the bad news is distributions are, well, I think more sort of neutral is a distribution with respect to a staking coin is income. And you know what you want to be doing is figuring out a way to take the position you're engaged in a trade or business with respect to your staking activities. You want to try to avoid perceptions that you're engaging in a passive activity, because passive activities and non-business activities are subject to a different tax regime that is much less beneficial. Specifically, you will be limited in your cost recovery. So for example, the cost to stake the coins would be deductible in a business context. Whether those losses are available to you in a non-business context is going to be a much more strenuous exercise. So whenever you're engaging in any kind of staking coin node, running a node for a staking coin or what have you, you're going to want to be focused on developing a business around that activity. And that's just, you know, that's something that, you know, CPAs, lawyers can talk to you more about, and you should ask your CPA or your lawyer more about that.
I personally, I have a whole bunch of follow-up questions about that, because it seems that it's a lot of kind of, you know, you have to take into account the market value of these coins and make that call between whether or not it's a business enterprise or just something more passive. But we only got like a couple of minutes left. I do want to take, there was a question or a couple of them that came through on YouTube, and maybe if you have a couple, you could take this question for a couple of minutes. So someone was asking, Rodrigo, with respect to international regulation. So he says, the IRS has the power to tax American citizens. What about the transactions of foreigners with permanent establishments? How will the countries cooperate to avoid double taxation? How will the jurisdiction be distributed? Yeah, so I think, and he has some other questions here too. But yeah, maybe if you want to take a shot at that with respect to international tax payments.
Sure. So the great news is that the rules that will apply in that space will be identical to the traditional tax rules. The fact that you're transacting in blockchain assets or digital assets in any form is irrelevant. The question will be, you know, do you have a permanent establishment in the United States? And if so, are you subject to a tax treaty between your home country of residence and the US? And then what is the, you know, what are the rules under that tax treaty? Ultimately, you're also asking a logistical question, though, which is, all of this tax has to be collected, and you know, what if I just don't do that? Right? Everyone's always like, what if I just don't do that? So the mechanism, the ultimate enforcement mechanism against internationals is through the banking system, which has so many ties to the United States. So every time a transaction is processed through a US bank, which most transactions ultimately will be, or a bank in a foreign jurisdiction that is cooperating with the US government, they will have access to withhold taxes on those payments. And if you, you know, if you're not already aware, that withholding tax defaults to 30% in most cases. And so you might want to consider whether you would save taxes by filing your tax return regarding, you know, appropriately reporting on your 1120F that you have a permanent establishment, taking your business deductions and mitigating your tax exposure accordingly. So that's something that it's probably not even worth it to try to even explore whether you actually need to pay those taxes, because you have a business to run, and so you just have to comply. And so the question you're asking can be answered by almost any qualified tax professional in more detail. So I can help. I can provide referrals if needed.
And of course, yeah, I see there are so many, like with each question, it just opens up a dozen others.
Right.
That's why I'm really excited for the event on March 6th and to hear you talk a lot more. It was really great talking to someone so knowledgeable like yourself. But yeah, so thank you, Alice. And then just again, everyone who's watching, the event is March 6th in New York. You can go to blockmedics.io. You can find the details through there. Of course, in general, just follow us. You can like this video, sign up for our newsletter, and check out our online courses as well. So Alice, thanks again. If